Ed Yardeni is president at Yardeni Research. He's now joining us. Ed, it's always great to have you with us here on the program. Thanks very much for your time. We go into this FOMC on Wednesday with, I think, consensus being that we won't see a rate hike. Even actually, the market pricing, the odds of a rate hike even after that are only, I think, about 15-20% or so. Is that the way you're seeing things?
Yeah, I think so. Right now, the Fed still is talking hawkish. Fed Chair Jerome Powell had an interview on October 19th where he stressed that inflation still remains above where they want to see it and that they're not sure whether monetary policy is restrictive enough. But he suggested that it's going to have to be maintained here for a longer period of time. Now, the issue is whether they need to raise interest rates more or just leave them right here for a longer period of time. And I think they're leaning towards leaving it at this level for a longer period of time because the bond yield has been tightening so much.
Ed, hi, good morning, and thanks for joining in. At a time when we do have this geopolitical crisis underway, markets have lost a bit of ground. How are you approaching risky assets like equities? Post the FOMC meet, what will the take be on risky assets? Are you cautious now, or do you think that the time has come to put some money to work?
Well, right now, I would be somewhat cautious over the next couple of weeks. The geopolitical crisis in the Middle East doesn't seem to be simmering down at all. It seems to be actually getting worse. There's a lot of violence going on right now between Israel and Hamas. And on top of that, there have been some skirmishes between the United States and Iranian proxies in Syria and Iraq. So I think the markets are going to remain nervous about that issue. Meanwhile, the bond yield is just kind of sitting here around 5%. I think if it suddenly jumps up above 5%, there'll be a lot of concern. Look, on Wednesday, Fed Chair Jerome Powell is going to give us his latest thoughts on things, and we'll summarize the FOMC meeting. But I think also on Wednesday, the Treasury is going to be announcing how much money they're going to have to raise in the next few months. And I think that'll actually be more important than what the Fed has to say. Right now, fiscal policy is the main issue facing the market, in addition to the geopolitical issue, rather than monetary policy.
All right. Hi, Ed. Good morning. So how do you approach a market like the Indian markets? Valuation-wise, we're not very cheap. We're trading more or less in line with our long-term averages. The problem is, earnings could get impacted because of higher crude and, interest rates if they stay higher for longer. So approach to Indian markets would be what?
Well, the global economic outlook isn't all that great. I mean, China is slowing down. Europe is still pretty weak. I think the U.S. strength in the third quarter isn't going to be sustainable, but I don't think we're going into recession. So India is part of the global economy, certainly. It's an important part. And is going to find that global economic activity may have some diminishing impact on domestic economic activity. But the good news for India, as we've discussed before, is because of the geopolitical tensions around the world, particularly between China and the West, I think we're going to continue to see money pouring into India as an alternative to producing in China. So I think India benefits from that at the expense of China.
Ed, you said the monetary side is not the problem in the U.S., it's the fiscal. I thought with the appointment of the speaker, that's kind of now looking easier, or not really? I mean, the deadline in November, the government shut down, I think, the debt limit basically, is that still alive?
Well, it's not so much the debt limit as it is the possibility the government will shut down, but that's not the issue that I'm referring to. What I'm referring to is just the absolute size of the deficit. We've never had a $2 trillion deficit like this in an economy that's growing. It's an all-time record high. And the concern is that supply suddenly matters. In the past, the bond market was mostly concerned about inflation and Fed policy. Now they're very concerned about supply coming out of the Treasury. So that's what I mean by fiscal policy being a main concern now.
All right, Ed, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV 18. That's the president at Yardeni Research talking about how he's a bit cautious on the market now, given that there is no sign of the de-escalation of the geopolitical crisis. So one doesn't know what the economic ramifications could be in the near future. Let's